Hello and good afternoon. I welcome you to today's Trading Spotlight webinar. Today here with Admiral Markets. My name is Jens and I'll be the moderator here for the upcoming, something like 45 minutes. And we'll have a look at the very interesting topic today. So in fact, we want to answer the question, what are futures and options? And especially, how do they compare to CFDs? So contracts for difference. And that's usually... You can't see me? Okay, that's interesting. 1 second. So one second. Why can't I see myself? Can everyone see me? All good here. So Robert says that that he can see me. So you can see the screen where the question is: what are futures and options are, and how do they compare to CFDs? And you can also see the camera. So that's me. Hello. So yeah, seems as if everything's fine. So probably okay. Yeah, perfect. So yeah, we want to answer this question, and that may surprise at first glance, because Admiral Markets, as you may know, is a classic FX CFD broker, but also offers now futures, for example, on the DAX, and in general can be considered a multi-asset broker. But still, it's a very interesting and important question to answer. And I hope that in addition to the to an introduction and the explanation, what are futures, what are options, I can give in addition to that an idea on how to use the knowledge, even if you do not plan to trade anytime soon, futures, options, plan to continue trading CFDs. I try to give you an idea on how to use this knowledge, in fact, in your trading, in your general trading, and hopefully I will succeed with that. And coincidentally, today is a special day, because today is the so-called triple witching. It's not just on the DAX, but it's also on US equities. And thus, it makes probably some sense to dig a little deeper into this topic than today. First of all, let's have a look at today's agenda. So the question is, what are futures? I'll give you an introduction here to that. And in addition to that, surely we will point out pros and cons of futures. Then I will also answer the question on what are options, give an introduction, and also pros and cons here. I will already say that you will be surprised initially. So to see only text, I will give you a theoretical explanation first, and then give you some graphics on how to get a better understanding on that. So just stay tuned, and we will have a look at the graphics, and in fact use this knowledge then from the theoretical, from the text perspective, from the graphics, and then bring this into the real world, in fact. And at the end, we want to point out the difference between CFDs and futures and options, and especially what makes CFDs more attractive, in fact, especially to small traders. I can already say right here, the first and most important aspects and biggest advantage of CFDs over futures and options is most likely that it's small money you can start with. That's probably a good way to put it, in fact. And it's not a big amount of money you have to put up to start trading, in fact, but you can start also with a small account, and then use this small account even in a very, let's say, professional risk money management perspective, very professional way here, and use even a small account size here to professionally trade your account. So that's me. My name is Jens. I'm 35 years old. I'm living in Berlin, in Germany, and that's probably the most interesting part here, because here we come directly straight to Admiral Markets, with 20 offices around the globe, in fact, and one is here in Germany, in Berlin. So it's 20 minutes from my office, in fact, and they have a presence here in Germany, but not just in Germany, but also a global presence and over 20 offices around the globe, in fact. And this is noteworthy, I think, because we are talking about a financial service provider here. We're talking about the financial industry, and based on my personal experiences in the past, not just in this industry, FX and CFDs, but also in the financial industry in general, So when I started, I worked as an employee with a bank, in fact, in the retail industry here. There was also high net worth clients, certainly, but we still refer to them as retail clients. And what I can say based on my personal experience is that people usually really prefer to talk to someone in their native language when it comes to financial questions. And so that's one of the reasons why Admiral Markets is definitely worth a deeper look, besides the very, very competitive offering when it comes to CFDs, especially when it comes to the DAX, the German index. In Germany, we usually refer to Admiral Markets as the DAX expert, with a very high and very competitive offering, not just in terms of commissions, conditions in general, but trading conditions when it comes to order execution speed. So just give Admiral Markets a deeper look, admiralmarkets.com, for further information on the services they provide. And if you then are looking for someone talking in your native language, I think you have a very good chance, in fact, besides German and English, to find someone in your respective language. So then we'll start right into today's topic, and want to answer the question on what are futures and give a short introduction on that, in fact. You probably have heard about this, and it's a quite common, quite common financial product you might come across over time, especially when you start trading. And we want to dig deeper into this. Just to give an quick introduction on what are futures, in fact. So obviously it has something to do with the future. It has something to do with future prices. And okay, that's interesting. You mean you never have traded futures, or you never traded in general? So if so, well, this is in fact not a big issue, because that's a quite good starting point here. But okay, you never traded futures. Okay, yeah. So I can say that that's quite interesting, probably. My way when I came to trading, before we introduced this, was I mean, I had a crush, let's say, a crush on mathematics right from the start, even before I got interested in the financial industry in general. And when I started out, I was right from the start, not just but it's not, I wasn't focused on equities at all. So this is usually the starting point, right? So to buy a stock or something like that. And to me, that was something which was not really interesting. So it wasn't really fascinating. But what I was fascinated about was options, in fact. So we will introduce this a little later on. But also futures. So one of the first books on financial products I ever read, besides technical analysis on financial markets, was an introduction to futures and options. And this was mainly, especially when we look at options, that was mainly due to the complexity, respectively, the mathematical background, and the pricing, how this product came to life, in fact. And this is where I started. And when I let's put it that way. So I went to a bank. I worked for a bank, and after I finished my traineeship back then, I went to university. Beside that, I then worked at a stockbroker, in fact. So I also traded equities. But right after that, after I developed myself, let's say, I got hired by a prop trading desk, and that where we traded mainly futures, in fact. So that's how I got introduced to all these products, especially from a professional perspective. So it wasn't really that I was focused on one product right from the start, but this is where my experience with this product comes from. So I traded futures, but it wasn't the first product I traded. Initially, I traded options, respectively warrants. Then I traded stocks, and then I traded futures. So that was my my way, or my path I followed. And after that, I then went into the FX and CFD industry, in fact. And so let's come back to the introduction to futures. So futures, or respectively future contracts, are financial contracts obligating the buyer to purchase an asset, or seller to sell an asset, in fact, and have a predetermined future date and price. So this is usually what futures have. And thus futures allow traders to lock in a price of the underlying asset or commodity. When we talk here, we usually consider futures to be a product of let's say, pure speculation, in fact. But the origin of futures is, in fact, in the, yeah, let's call it in the commodity industry, especially when it comes to agricultural products here, like wheat or sugar. And just imagine you're working in this industry, you have a business here, and you want to lock in a price. So you want to lock in the price. That means you have the physical good, let's say wheat, for example, and you want to make sure that you're not dependent on climate changes, or on rain or heat or something like that, and you just want to lock in a profit. So you have the physical product, and the future allows you to sell this product at a certain price in the future, once the guy who bought this future from you then takes your this sold amount of, in this case, wheat, for example, from you. So this is where the origin of futures comes from, in fact. And here at this point, the second point, I already have this bullet point open here. A future contract usually allows you as an investor or a trader to speculate on the direction of a security, commodity, or a financial instrument. But this is not where futures come from, respectively, based on which futures were introduced, or where their initial origin comes from, in fact. So in fact, it's more like they are used mainly back in the, let's call them the old days. They were used as an instrument to hedge price movement of the underlying asset, to help to prevent losses from unfavorable price changes, respectively, to have a how can we say that, to have a fixed price based on which you can do your business calculations on, like selling wheat, selling sugar, agricultural goods, for example. And as I already pointed out, futures have an expiration date that are known upfront. So for example, usually you have, and let's take a financial instrument now. Let's have a look at the S&P 500 or Dow, or in our German case here, it's the DAX, the German index. Here we have 3 expiration dates of the future contract, the FDAX, which is usually, that's why this is interesting, because this is usually the reference market based on which your prices in the CFD occur then in your trading platform. So a CFD, contract for difference here, is usually an OTC product, which is not obviously traded at an exchange, but over the counter, we call this. And but you need to know where this price comes from, also to know whether it's a fair price or not you're trading on here. And you're usually, or the broker / the liquidity provider of the broker usually uses the future DAX contract in this case, in case of the DAX, but also in case of the Dow Jones, S&P, he uses the future contract, the price, which is found at an exchange via trading, where we are matching supply and demand here. And these future contracts, nevertheless, they expire. So when we go back to these agricultural goods, for example, as I said, you're selling the good here, let's say wheat, let's say sugar, and you know that you need to deliver it at a certain date in the future. And this is now where the expiration comes into play. So based on this expiration, you can say, this is the date once I have to deliver, in this case, the good XYZ. And the same is true for the DAX, for example. And these future contracts, they expire 4 times a year. It's in March, it's in June, it's in September, and it's in December. And it's usually the third Friday at each of these months. So the third Friday in March, the third Friday in June, the third Friday in September. Look at today's date. It's the third Friday today. So this is today the triple witching. It's in Germany, we call this Hexensabbat, or big expiration, großer Verfall. It's usually the word we're using here. And then it's the third Friday in December again. And after that, the contract then is not traded anymore, but then you trade the FDAX, and which expires on the third Friday in December, for example, and then it goes on, and then usually this is the way it's traded. And but now let's have a look here, first of all, at the pros. So we want to look at pros and cons. So when you talk to traders, usually you hear, especially professional traders, bigger traders, they usually say, well, there's no way to trade another a product than a DAX future, for example, or the future on the S&P. And this is mainly due to the fact that future contracts, all the ones I just mentioned already, and all of the beyond that are usually standardized and highly regulated and traded on exchange, in fact. So, which is usually considered to be the most transparent way to trade such a financial instrument like the DAX, for example. And as I already said, investors can use future contracts to speculate on the direction, on the price of an underlying asset, but especially the next part is important from a business perspective. So usually, I mean, we as speculators, we consider markets to be, most of the time, to be something really abstract. But I think most of us usually use the point that an exchange or that the trade itself usually serves a purpose of, especially companies, for example, to hedge the price of raw material or product they sell to protect from adverse price movements and to make profitable business in this case, and for example, to employ people, to add to the overall value of an economy, in fact. And in addition to that, future contracts might only require a deposit of a fraction of the contract amount with a broker. But here, I'm not sure. I put it on the pro side, but as I already mentioned, usually you have to trade a quite big amount, in fact. So let's or you have to deposit a quite big amount. So you have to have a quite big account size to trade those futures. So that means, for example, when we look at the DAX, currently trading around 13,000 points, something about that, 13,200, I think. But let's use 13,000, and we have a point value of €25 per point. That means once you buy one future DAX contract, in this case, you have to deposit something like 13,000 maintenance, and then we have initial margin in addition to that. So something like, I think, 25,000 or so euros margin, depends on the broker you're using here. And therefore, you're then moving an amount of 13,000 multiplied with 25. So you're moving over 300,000 euros in the market, which already means that if you have to deposit to open one DAX contract of something like 20 to 25,000 euros, you can already see that it's not possible to trade a small account, but you have to really to deposit a large amount of money, in fact. And in addition to that, now to apply risk money management or solid risk money management based rules, like never risking more than 1% of my equity. If we say 25,000, you only allowed in this case to have a risk here, in this case of 25,000, 1% of that is 250 euros. If we have a point value of 25 euros, that's the stop width of 10 points, which is nothing. I mean, this is like, it's not even a 1 minute chart. And you see that to apply a solid risk money management rules, you have to deposit a large amount of money here, in fact, to trade one future contract. So that means this is where we then come to the cons in this case. So investors not just have to deposit quite large amounts of money, but in addition to that, they have not just large loss potential in terms of point euro wise, USD wise, whatever. But in addition to that, there's also something else. There is no so-called no debit policy. So when you open an account with Admiral Markets, for example, as a retail trader, your potential loss is limited to the amount you deposit in your account. So your account can't go negative. That's a very, very big pro when trading a CFD and a big con when you're trading a future. So if there's a move like, let's say, the S&B taking away the pack of 120, So we're talking about Forex here, which makes it a little difficult because usually Forex is traded OTC and not via standard contract, like a futures contract. But this gives a very good explanation on how this could happen. So just imagine you have a position, or we can also say an overnight gap, or in case of overnight, it's difficult, but over the weekend, a weekend gap, let's call this. So it could be that there's whatever event happening over the weekend, and your position you're taking over the weekend in the DAX opens at a very unfavorable price, which wipes out your complete account. Like, let's say you have 25 euro, 25,000 within your account. You have a position over the weekend, and then the DAX gaps something like 500 points for whatever event. There's an earthquake or something like that. And that means you have to have your 500 point move against you. You have to multiply this by 25, which means you're then at something like, where do we, sorry, I just lost a zero, by the way. So that's not very good. Bad example. So I was talking about 10%, but it's 500. It's 100 point. I'm sorry. But this doesn't really matter. You have a move then of something like 500 points against you, let's say, and your account is wiped out. So just imagine you have a 10,000 euro account, and your market moves 500 points against you, multiplied by 25 euro per point. That means 12,500, which means you're then negative by 2,500 euros. And this is what you have to send the broker, because the broker will say, well, this is not just a margin call, but in addition to that, your account is negative now, and you have to deposit another 2,500 to bring your account back to zero. This is what it's meant by no debit policy then. And this is usual in the future world, let's say, or in the future trading world. So there's this risk of going negative, in fact. In addition to that, I already mentioned this between the lines, at least, that future contracts are usually quite heavy, which means a significant account size is indeed is needed here to make solid risk money management possible. Then that's what I meant, and that means also that it's very difficult here to scale positions adequately. And in addition to that, there's also this expiration component. So some of you might say, okay, this is really an issue. Well, just imagine you're taking a position and you plan to hold it for, say, 6 months or so, or 10 months, 12 months, whatever, and it expires after 3 months. That means nothing more than you have to, in this case, oh, by the way, I'm sorry, you have then to roll over a position into the next contract, which means there's costs involved to have this position rolled over, for example. So you have to close the one position, you have to open the another, which means it adds up the longer you hold the position, in addition to potential losses which might happen due to the position going against you. You have to roll over the next contract and probably deposit more money within your account. So it's quite difficult in comparison to a quite self-explaining way to trade such a position, a longer-term position in the DAX, for example, when we look at the CFD, and in this case of at Admiral markets, the so-called continuous contract we look at here. So these are the pros, the cons when we look at futures, very roughly speaking, and just looking at it, looking at it from a quite rough perspective. But now we want to look at options, in fact, and we want to look here at the idea behind options, in fact. And so options, if you're a buyer of an option, you buy the right, but you do not buy the obligation, which is a big difference when looking at the when you compare futures to options. So in case of options, we are looking at a right. In case of futures, we are looking at an obligation. Okay, so if you are a buyer of an option, you buy. You call option, we call this, or you sell. This is the case of a put option, the underlying asset at a preset price called the strike price. So you can already see that's somehow difficult way to probably understand it already. And this is just the beginning. So we you buy the right to buy or to sell the underlying asset at a preset price called, which is the strike price. And so options have a cost associated with them, which we call the premium. So this is usually what you have to pay. So the premium you pay the option seller, and then you have also the expiration date. And this is where this will bring us to something which is necessary to consider in case where in terms of who am I, if am I the right person to trade options, because we have a dependency here, not just on the price but also on the time. So there's a price and the time dependency here, and this could mean stress because the market has to move until a certain time, or the expiration date has to trade above or below a certain price, which could result in stress, emotions, and thus in decisions you take, which will naturally affect your trading, usually in a negative way. But this is something we will look at when we look at the pros and cons when it comes to options. So first of all, we want to look at the details, or let's say the theoretical idea behind options a little deeper, or dig deeper into this topic here. So a call option is profitable when the strike price is below the underlying asset's market price, since the trader then can buy the asset at a lower price. Is it right? Is when the strike is below the underlying? Yeah, sure. Yeah, it's below. You will see this in a graphic then, in fact. So which means, like, let's say you have a strike price of 100 and the market moves to, let's say, 150 in whatever asset we look at, let's say stock XYZ. So then the market trades, the stock price is 150 euros, but you're allowed, since you have the right to buy, you just bought the option here, you have the right to buy the asset, the stock, at 100, in fact. So 50 is then the difference, the profit you make on this option, in fact. And the same is true for a put. This is probably a little better to understand, because you can understand a put option as if you're a long put, that means that you bought some kind of, let's say, insurance, in fact, to insure your portfolio, for example. And once the market moves beyond or below a certain threshold, you're then allowed to sell, in this case, your stock at a higher price, in fact. And so a put option is obviously profitable when the strike is higher than the underlying asset market price, since the trader then can sell the stock at a higher price. Let's now look at the pros and the cons of options, and then I'll give you a graphic idea behind what we just talked about, in fact. So first of all, options are standardized, highly regulated, and traded on exchange. Same true as for futures. And investors can use options also, as they can futures, to speculate on the direction of the price of an underlying asset. So if you think that the stock or index like the DAX will go up, you buy a call option. If you think it will go down, you buy a put option for the opposite direction effect. So it's important to see that you buy the call and to buy the put, but it's not that you sell a call. This is something completely different, something we will look at a little deeper in a few minutes, in fact. And again, companies here can hedge the price of raw materials products by selling to protect from adverse price movements. Same as here true. So they can insure their portfolio by buying puts in this case. And the potential loss of a long, respectively, a long call, respectively long put, is limited to the premium, which is very important, which is very, very important. This is one of the big pluses and advantages when trading options. If you paid a premium and the market does not move beyond your strike price, if you're a long call, for example, the option just expires, and you already paid all the amount you could pay by paying the premium, in fact, which is very, very important to understand, because it gives you, from a risk money management perspective, some insurance you do not have once you have bought a future, for example, or sold a future. But now the cons, and this is something which is also important to trade, or once you trade options, it's not just purely speculative, but sometimes you use options based on the profile to create quite complex payout structures. You can use them. For example, iron condors, or you can trade volatility by buying a straddle, for example, or a strangle, or iron condors, or, well, there's plenty of opportunities, in fact. So very, very difficult, sometimes very complex structures you can create by options. And in this context, it's also important to note that there's not just a chance to buy a call or to buy a put, but it's also obviously possible to sell a call or to sell a put, in fact. And here you then, as the writer of the option, you have, in fact, unlimited risk of losing money, in fact, which is also something which becomes interesting in a few minutes once you see the profiles. We will look only at the long call, long put option, but once we are talking about short call, short put, then you become aware of the fact where buying pressure or selling pressure could result from, or could come from, once these market participants start to hedge their exposure, once they have to hedge their exposure, else they're facing the risk of a big loss, in fact, on one or the other side. And again, here, let's come back to the cons and make it very simple. You have, again, no debit policy, which is the same as, where it's similar, same is true here for futures, in fact. And in addition to that, there's also something which is of interest and why it's very difficult. Some of you probably have heard the stories recently, something like 2-3 weeks ago, around SoftBank, who became a big buyer in the options market, and which was one of the main reasons why equities shot higher. And then the mainstream financial media tried to explain what just happened. And I had to laugh, because I just imagined someone who has no knowledge of options and in general to understand what dynamic delta hedging means. I mean, it's a quite simple concept. We don't dig into this concept today, but it's simple to understand that. But for someone who has never traded an option, it's nearly impossible to understand what drives the price higher here in the underlying asset, like an Amazon stock or Apple stock, for example. And so this is a perfect example of why options are usually considered quite complicated and quite complex, in fact, because the pricing of an option, and to find out whether an option is a fair product or fairly priced, depends on so-called Greeks. And there you will come about components like delta, like theta, like theta, like gamma, like vega, like rho. So these are the Greeks we look at here. And so this is also a big plus when it comes to futures, but also then when it comes especially to CFDs, because these are usually very transparent products. So you look at them and you know the price and whether it's fair or not. So you look at a CFD price, you see the reference market to future, and you can see, okay, obviously it's a fair price. Once you trade an option, especially an OTC option, you don't really know whether the price is fair or not. And in regards to transparency, this is a big plus of CFDs in comparison to options, even though options might deliver some quite interesting structures or payout profiles, which usually are very, very individual and can help out to create a profile which perfectly suits your investment profile. But you pay a price for this in terms of transparency in this case, especially if you do not know what you're doing. Also, in addition to that, on exchange options are standardized and also quite heavy. We don't dig too deep into this, but also you can see when looking at this example around SoftBank, for example, where this heavy component comes from. And in addition to that, there's also this expiration component. So that means the market has to move beyond a certain threshold, the strike price, to make sure that your bet, your trade, becomes profitable. If it doesn't move beyond that threshold, if it does not cross the strike price in one or the other direction, the option just expires worthless, and the premium goes to the one who sold this product to you. So now, let's have a look here at the payout profile. Long position future. So this is usually how this is playing out, and there you can see there's no asymmetrical risk profile. What I mean by that is you will see this when we look at the long call, respectively long put, we only pay the premium. Once the market moves against you, it moves indefinitely against you. And this is one of the reasons why, in case of a long future position, for example, you have to have, especially due to the high leverage you're using here, you have to use a stop loss and make sure that you know when to exit a trade. There's also the equivalent then here for a short position. Once the market drops, so this is where the x-axis here is coming into play, you make money on the short side, while if the market rises against you, the same as for CFDs, for example, you're losing obviously money once the market rises if you're short. So this is the enterprise. And now let's have a look here at long call. I think this is more interesting, and especially interesting in regards to what I just prepared for you. So you have a long call here in this case. So this is the premium you pay. And once, let me just see. Yeah, once we move beyond the strike price, and there's the premium you have to pay, this option becomes it becomes worthy. So you make money on the trade, in fact, if the market moves here above the strike price. And there's where this asymmetrical risk profile comes from. So this is the price you pay, and that's it. So you're not setting a stop, in fact, but the stop is the expiration date. So if the market here does not trade above your strike price, your call option just expires worthless. That's just it. And we have the equivalent here for the short side in this case. So this is the put position. And there you have also the strike price. If we drop below the strike price, you're obviously making money. You pay the premium. If the market fails to drop below the strike price, your option again expires worthless. We will keep this open, in fact, and now have a look here at something I prepared. We just want to go through this quite quickly, but let me just try to try to explain this to you. So I've opened a website which is completely free for you. It's the CME. I will share, for those watching this video now on YouTube, I will share the link here on in the description box, and I will also share it here in the chat box now. And you can open this. And what you see here, we won't explain everything now, but it's from this Chicago Mercantile Exchange. It's from the Globex, and it's the so-called open interest. And here we look at the Euro future, Euro FX future, and we have 119 here, and there it says 119 call. So let me just go back here to this part. It's a call, and there we have the strike price. So this is 119 in this case, okay? We're trading below 119 right now. It's Euro is trading something like 118.60, 118.50, if I'm not mistaken. So slightly below 119. And now the interesting thing is, if we move above that level, obviously someone who bought this call makes money on the trade. But now things are getting interesting, because you wonder, okay, if someone bought the call here, someone must have sold it, right? And this is exactly right, because someone who sold at 119, how does his payout profile look like? It looks the complete opposite here. So this is the short call. Let me just write it here. So he's losing money once the market moves above 119. So because then here, obviously his position is losing money. He's making money once the market here trades below the strike price, but once Euro goes beyond or above 119, obviously this market participant will lose money. So what will he do? In this case, first option is to defend the level, to say, no, we're not letting Euro rise beyond 119. That means there's a natural resistance out of this, which is very interesting from a research perspective then. But also what you could do if he fails to defend that level, for whatever reason, there's a fundamental news going over the ticker, like, I don't know, ECB does not plan, ECB hikes rate, let's put it that way. That's very unlikely, but if this happens, you can be sure that there will be massive buying happening and pushing the Euro above 119. So what this market participants who just sold the call here with a strike at 119 has to do, he has to buy the Euro and add further fuel to the bullish momentum, which obviously happens then. to hedge here this part of his option. And what happens here, let's probably assume that he will buy somewhere here, like 119.30 or 119.40 or something like that. And what he will achieve is he will flatten this part of his payout profile and make out of a potential big loss a small loss by hedging the exposure by buying the euro here. So based on that, it's very roughly it's very rough explained in a very rough way. But what you can see is that knowledge around the payout profile around options becomes something of high interest once such a level of a high open interest is attacked, respectively, the euro breaks below that level. The same is true here for the short side, or in this case for the puts. You can see the puts are in orange, so you can see here that this column is even higher, which means nothing more. It's 117 put, which means like we just mirror this payout profile here, and we know, okay, once the euro drops below 119, there will potentially be further selling pressure happening out of the fact that market participants who sold puts have to hedge their exposure because they are losing for every pip the market drops further below 119 for 117 in this case. So this is quite an interesting way to use options as a way to analyze and expect bigger moves to happen and further dynamic to take place, in fact, here. And where this graphic probably helps out to understand dynamic moves beyond a certain threshold, and also explain why in the financial media, especially among professional traders, option markets are usually of high interest, because this the developments in the option market, based on also the weight of the option market, can really add fuel to dynamic moves in one or the other direction, and becomes of high interest, in fact, for market participants. And so now we want to use, or have a look here at the attractiveness. We want to look at the attractiveness of CFDs compared to futures and options. And even if we're planning, if we do not plan to trade futures and options, it's definitely worth to give it a deeper look, as I explained before, due to this dynamic which could occur once option interesting levels in the option market are broken on the up or on the downside, in fact, because then you can try to profit from that even with a smaller product, or not so heavy product like a CFD, for example. So what I usually do when talking about CFDs is that I usually refer to CFDs as small futures, which is not entirely true, since futures are on exchange traded and standardized expiring contracts, while CFDs are OTC products and usually continuously traded, as for example, the continuous contract when trading the DAX with Admiral markets. But in regard to pricing, CFDs are as transparent as futures, in fact, even though very good scalable due to its micronization. At Admiral markets here, you can trade, for example, the DAX CFD as low as 10 euro cent per point compared to the 25 euro per point in the FDAX. There's also now a mini FDAX, which is then 5 euro per point, but still quite heavy compared to DAX CFD, which is usually only 10 cents in case of 1 point. And that said, I prefer futures over options due to the transparency, since options are very, to some extent, intransparent when it comes to the Greeks. They're very difficult to say whether the price is fair or not. This is especially true for over-the-counter options, not necessarily for on-exchange options. And still, I prefer CFDs over futures due to the scalability and then this component, in fact, when it comes to risk money management components, in fact. And also very important, again, the no debit policy, which could result in additional funding obligations. So CFD retail traders have no debit policy, and thus their risk is limited to the account balance, and that's it. So there's no a bad awakening in the morning. So when you wake up, you look at your account, it's minus because there's a big gap down, big gap up against you, and you have to pay your broker whatever amount. So in case of CFDs, this is definitely taken out if you're a retail client. So now let's sum all this up. I just have a look here, a quick glance at the watch, and then so I think I have to hurry up a little. So summary: futures and future contracts are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset and have a predetermined future date and price. Options give a buyer the right and not the obligation to buy, call option, or sell, so put option, the underlying asset at a preset price, which is called the strike price. And again, CFDs are more transparent than options and similar in their pricing to futures, but can be scaled better, which is not just attractive for small account sizes, but also important from a risk and money management perspective. So that's the summary of today's webinar, in fact. Next webinar here in Trading Spotlight, in our Trading Spotlight webinar series is Monday with Paul, which will explain to you how to read candlesticks here, especially for beginners. So it's a beginner's special in this case. And the webinar with Paul will include what is important for beginners to know about candlesticks and how a beginner can here interpret candlesticks for his trading and then get started with it. And he will also look with you at a few important candlestick formations. The webinar will take place Monday, 2 p.m. London, and 21st of September. So check your inbox for the webinar link. This is especially true for everyone who is right here in the live event now. And if you watch this on YouTube, if you just enjoyed what you have seen, then please leave a thumb up here, comment, questions, whatever. Also head over to our Trading Spotlight community. 1 second, I will go through the slide in the next one. And if you want to be here in live and ask your questions live, then head over to admiralmarkets.com to the Educations tab, webinars, and there you can register for the Trading Spotlight webinars. And here is the Trading Spotlight community. So tradersyard.com, there you can join our Traders Yard Trading Spotlight group. Ask all your questions, not just questions you have here for me, but also for Marcus and also for Paul. And yeah, just head over right now and ask your questions. I'll be there in a few minutes to share my thoughts on the S&P, in fact, and more analysis in addition to that on admiralmarkets.com. Here are the contact details, and this is the risk disclaimer. This is from my end. So have a nice weekend. Enjoy yourself. Talk to you again next week on Friday. I look forward to it. Have a nice weekend. See you soon, and